Thank you, Stephen. Good evening, everyone. On behalf of HSBC Securities, I welcome you all for the Tata Motors quarterly results conference call. I'm very happy to introduce the Tata Motors management team. We have with us Mr. Gunter Buschek, MD and CEO, Professor Dr. Ralph Speth, CEO, JLR, Mr. PB Balaji, Group CFO, and Mr. Adrian Mardell, CFO, JLR, along with members of the Investor Relations team. Thanks again to the team for their time. We will start the session with some commentary from the management, followed by Q&A. But before I hand over to Balaji, I would like to wish a very happy Diwali to everyone on the call. Over to you, Balaji.
Thanks, Yogesh, and wish you the same too, and wish all of you a very happy Diwali, and hope you get some time to spend with your loved ones over the weekend, which is what I intend to do in any case. We have, along with the rest of the people that Yogesh just referred to, we also have Girish Wagh, who heads our CV business, where I'm sure there's a lot of questions that you would want to ask of him as well. Let me cut to the chase. As like last time, it will go quite fast on the slides because the time needs to be spent on the Q&A. And without further ado, let me draw your attention to the safe harbor statement and then go to the key activities developments for the quarter, which most of it you have seen in the press, including the launch of the new Defender that we had, the new infotainment system, Zipron, the new EDU drive that we have, and of course the new product launches that we have. So an exciting quarter nevertheless, and that keeps continuing from our end. On the numbers, really reassuring and delighted to see the JLR performance coming back and starting to improve. Unfortunately, of course, on the Indian market situation, which we have been discussing for quite a while now, has been a very sharp market decline in the Indian business. And we'll talk about that more in the coming slides as well. And in the case of China, JLR, if you recollect, we did talk about the China recovery, and it's happy to see that now translating into numbers on our side. And as far as the EBITDA margin is concerned, this is amongst the highest that we have seen in the last 15 quarters. And therefore, it's a good delivery of numbers that we have. On the JLR side, the delivery has been led out of a better mix, better charge delivery, as well as higher wholesales. But in the case of India, almost the entire number decline can be attributed to the M&HCV slowdown, and the resultant mix being poorer because of that. Overall, the cash flow at 1,500 crores negative, significant improvement from what we had in the same time last year. And JLR is almost now cash neutral for this quarter. And in the case of India, as committed, the stock and debtor situation has significantly improved, and creditor is just the optics of how the growth translates into creditor days. Wouldn't spend too much time on the growth breakup, barring to say that highlight of our focus on retails being significantly higher than wholesales. We've continued to execute in the case of Tata Motors, whether it's essential in the BS6 transition, and I'll again talk about that in the subsequent slide. So moving on to slide 6, which is the EBIT waterfall that you have. The 1.7% EBIT improved by 4.4% because of JLR delivery, pulled down by Tata Motors by about 2.6%, and others being broadly flat. And that is how you see the performance there. We'll take a little bit on the time on the preferential allotment that has been, the board has decided to allot shares to the promoter, Tata Sons Limited. And this is in a situation where the business has delivered, both in JLR and in Tata Motors, consistently delivered a strong turnaround. But the near-term demand situation, particularly in India, being fluid, and the debt levels in the standalone business being high, the board has decided to raise this equity through a preferential allotment. And this will come as a combination of shares and warrants, and that will be at a premium to the last 5-day closing average price by almost 11% at an issue price of 150. And this is a significant premium to the closing price by almost 18%. And there's an expected proceeds of close to about 6,500 crores, of which 3,892 will be received up front, which is both for shares and 25% of the warrants. And the remaining will be there when the promoter decides to convert the warrants into shares. And this takes up, post the exercise of warrants, the ordinary shares, the promoter hold in the group's holding in the ordinary shares will be about 46.4% and a voting rights of 45.7%. This is a very fundamental intervention because first it of course strengthens the balance sheet of the group as a whole, and particularly the domestic standalone balance sheet. It provides rating support for the group as a whole. It limits dilution because if it's the rights issue, it would have diluted us even more. This limits the dilution and also signals a strong conviction of the promoter on the Tata Motors opportunity that we have. And of course benefits all shareholders because it allows the business to continue to invest and also executes its growth strategy that is there. So this is a very key intervention as far as this quarter is concerned. Let me pick up speed in terms of numbers. You've seen the JLR numbers, which is on slide 10, which basically an EBITDA of 13.8%, a growth of 8% in revenue, and an EBIT of 4.8%. This is as you would you will agree with me that this is a well-rounded delivery that has happened from JLR, be it on revenue, be it on wholesale volumes. Retail is also broadly there. Strong performance coming through in China, albeit of a weak base, but the headline numbers starting to stabilize and improve, and the new launches firing well. And of course, from a cost side, we see Charge delivering as we had planned, and at the same time, we also have lower D&A overall. So let me now hand this over to Adrian, who will give you more flavor in terms of the performance of JLR, which is probably the highlight of the day. So Adrian, over to you.
Thank you, Balaji. Good evening, everybody on the call. As Balaji just said, that's our Q2 performance, revenue up 8%. Favorable mix as well as increased volume in the quarter. Retails were slightly lower, but strong performance year over year in China, and the Evoque came at the blocks really well versus old model. Profit, as a result of which, was significantly better, those volumes, but also the Charge impact of lower operating costs, D&A, and favorable FX for the first time in a long time. And as Balaji also said, we were nearly break even in the quarter, a large £559 million better than the quarter last year. The higher profits, the lower investment, and we did also receive a grant of 65 million euros from the Slovakian government in the quarter. On the sales volumes, two stories of note. This continues with the discussions we raised in the July call. China was much higher in the quarter, 24% than the same quarter last year. We indicated that in July, and also the overseas markets were much lower, as they were indeed in the first quarter, and that pattern in overseas is likely to continue in the second half of this year. If I do the same by model, I've mentioned already the Evoque compared to the prior model in the same quarter was up significantly, 54%. The models that weren't doing so well, each of those are up for model year upgrades, 20 model years for Discovery Sport, and the XF, and there'll be a model year upgrade coming along on Discovery within 12 months or so. Range Rover Sport doing particularly well, again, as mentioned earlier, driving the high product mix. Next one, if you would, talks to a waterfall chart that defies gravity. That's nice to see for a change, isn't it? So last quarter we were losing 90 million in Q2 FY19. The 166 is actually before exceptional items of £10 million. So the PBT pure was 156. And you can see there are lots of positives in lots of places, included at higher volume, higher parts and accessories as the car park grows. There's still opportunities for us to improve. Our China JV business certainly was worse in the quarter again, as we indicated. We've done a lot to stimulate incremental volume. We have 4 new product replacements happening over the next 6 to 9 months, and we would expect that performance to improve going forward. VME was higher again. You've seen the other announcements, including the premiums, more difficult to sell cars in the marketplace, and VME is one symptom of that. We did actually take a £25 million residual value reserve, additional reserve, on our 16 model year Range Rover and Range Rover Sport products, which we booked in Q2 as well. Don't anticipate additional reserves required on those model years. Really good news on cost control in several places, driven by the Charge program, as we talked on several occasions. Manufacturing, material costs, fixed marketing, selling costs, all were lower than the same quarter last year. We did have a technical advert on labour and overhead, which is code for inventory reductions this quarter versus last year, and our interest charges are higher as well, as you would expect. As I mentioned earlier, FX was positive in the quarter versus the same quarter last year, as we're starting to see the operational benefits of a weaker sterling outweigh the contracts that are now running out over the course of FY20. If you go to the next page, cash flow, almost break even. The profits, obviously, the cash profits were higher than we've seen of late, £870 million worth of cash profit from through the income statement EBIT lines. Investment was a bit lower. We said the control on investment would continue. I do anticipate that growing in the second half of this year, but it was only 841 in the second quarter. And we had a series of events in working capital, the biggest of which was actually an adverse increase in our receivable balances versus the end of June, mostly as a result of the selling rate at the end of September being much higher than the end of the previous quarter, which drove a free cash outflow of just £64 million in the quarter, $559 million better than the same quarter last year. Capital investment, that's the breakdown of the investment, less capitalization of product development costs, as you would expect, and also the capital investment was a lower number than last year as well, down $154 million on the same quarter last year. News on funding. We raised with you last time. We'd completed the receivables facility early, in fact, right at the end of FY19, and we'd drawn money on that in quarter one. No additional drawing downs on that in quarter two, so we're still about $300 million of that facility used to date. 2 additional loans have actually gone in place in October, so not in the quarter numbers, not in the quarter cash flow, actually happening in October. We completed quite a unique deal, which was backed by the UK Export Funding Guarantee. 80% of that £625 million deal was backed by that guarantee. That was completed this week, and money has been drawn down this week. And we also just today completed a second deal with Black Horse Financing on buyback fleet deals, fleet vehicles we buy back from the marketplace, mostly our own management car vehicles, which basically fund the flow of vehicles as they come back before they're refurbished and sold into the marketplace. That deal is short-term through to the 31st of December 2020, secured on the vehicles being bought back. We also will look to take the opportunities as we need to over the course of the balance of the fiscal year, as again we've discussed with you previously. Look a bit at the strategic areas. No change here. The reason why there's no change is the plan is actually working. So the turnaround in transformation plan is underpinned by strong new product launch in pipelines. You've seen the impact of the Evoque as we've launched it over the last quarter versus the previous model. We've got an amazingly exciting Defender coming at us at the end of this fiscal year in the spring, which we're really excited about. Project Charge is starting to deliver in all facets of the program. Investment, inventory, people costs, and overheads are all impacting now dramatically the data. To date, over the 4 quarters, Project Charge has delivered £2.2 billion. And if you compare the last 4 quarters to the previous 4 quarters, you see the improvement in cash is almost exactly that same number. And then Accelerate obviously will come along later, as we've discussed before, fixing some of those fundamental issues that we still have to resolve within our business. Next slide, if you would. The amazing Defender, I can't do it justice to talk to it. What I would like to say is we've had at least 640,000 complete configurations of this vehicle, which is significantly higher than other vehicles we brought to marketplace. So our anticipation on this vehicle selling well is cautiously optimistic, let me say. So if any of you on the line are interested in taking one, you might want to put your order in quite early. Next page. These are all the fantastic reports we've had through the press on this vehicle. It's highly anticipated. It's creating amazing talk on social media, and we're very, very proud of this new vehicle. China, as you know, has been an area of challenge for us over the last 18 months or so. These are the KPIs we put in place. All of these KPIs continue to be positive. So the retail targets were again met through quarter 2. The retailers are profitable in quarter 2. They did have a dip in June, as we explained last time, because of the clearance of the old CN5 units. Very importantly, most of those sales are local registration sales now, and that went through in September our target of 85%, which is industry benchmark level. And retailer stocks are also falling down to our target areas of just over 1.5 months. Finally, on the bottom there, you see the actual sales versus the marketplace, where we are up over the previous year when the market is actually flat. Project Charge, these are the 3 areas. We said we would deliver $2.5 billion before March 2020. Investment is already higher than that. You saw the relatively lower investment number in quarter two. Working capital will go beyond its target in the second half of this year, and we're now starting to see increases come through in the important cost and profit area. Next slide, if you would. These are the areas for the 1 billion challenge on cost and profit. Last year we did 150 million. Of course, you're aware about the Sapphire program. You can now start to see for the last 2 quarters significant reductions in people costs, 150 million over those 2 quarters. Material cost performance always kicks in as you go through the year, and you would have seen that kicking in the waterfall chart on profits for 40 million in quarter 2, and our overhead costs were a little bit lower than quarter 1, actually, in quarter 2, so we're progressing really well with our overhead cost target. And finally, because we know the EBIT side of the cash improvement is so important, we're already designing the next stage of Project Charge, even though there's still 6 months to go. But we do actually think we will complete the 2.5 billion charge benefits at least 3 months early, and we'll announce much more detail on the next stage, which will have more EBIT focused when we talk in January. Finally, the targets have not changed from the targets we showed you in July. So EBIT margin is still 3 to 4% range for this and next fiscal year, although again, I will repeat as July, we are likely to be at the lower end of the range this fiscal year. PBT is increasingly positive and will be in half 2. Investment spending will be lower than 4 billion, likely to be close to 3.7 billion this fiscal year. Free cash flow is negative. You saw the negative again in Q2, but it is improving and will be stronger in half 2, and our gross debt to EBITDA up to the 2.8 range. None of that guidance has changed. What we will do is we'll continue to focus on launching those new vehicles which you saw, the anticipation in the market. We'll continue to improve profits in the second half of the year and to drive down the cash flow through our charge and accelerate programs. And we will actually design our next stage of Project Charge before the completion of the old program and bring you further details of that when we talk in January. Balaji, I think it's back to yourself.
Thanks, Adrian. Quickly getting on to Tata Motors, I think the focus of this quarter has been, having recognized the slowdown is now definitely upon us. The entire focus has been ensuring that we manage the slowdown by doing it right. It required a bit of a deviation from how we have been approaching the turnaround 2.0. But if we rephrase turnaround 2.0 is about ecosystem viability and not just our viability, I think it's just to hit the right spot of what we have to do. So the entire focus has been to ensure the ecosystem viability remains. So we are quite happy that we reduced our system stock by almost 3,400 crores during this quarter. TML knocked off about 1,000 crores of stock, and dealers knocked off about 2,500 crores of stock. And we can talk about this later if need be. Obviously, this then results in an implication on what it does to your top line and the shape of the P&L. It is not a P&L that we really like, but I think it's a P&L that we have to lump in simply because that is the correction that needed to do on the system stock levels. And we didn't want to do any underlying kind of numbers, but just to lay it out there for you, saying that we are happy to see retails being higher than wholesales by almost 23,000 units, and quite disappointed with the revenue drop of about 44%. At an EBITDA level, I think this negative EBITDA does rankle and does hurt us, and we are absolutely determined to correct it. But I think this was a bitter pill that we had to swallow this quarter. And this decline in the profitability is almost entirely explained by the M&HCV decline, which I will talk about in a while shortly. And at the same time, we are also we had to take a write-off of about 230 crores in the passenger vehicle business this quarter on those models and those platforms that we don't intend to take forward looking ahead. As committed last time, the free cash flow is significantly lower burn this quarter compared to last quarter, and I'll talk about this in a while as well. So moving on to slide on the profitability waterfall that you have, you would notice it's almost entirely volume and mix that is declining the numbers there. And out of the 1,500 crores that you see as a decline in the profitability because of volume and mix, 1,200 crores of M&HCV decline can be attributed to that. So it's almost the predominant chunk of that. The cost savings are firing quite well. Even if I look at the variable cost line, is almost the bulk of the increase that you see there, or the increase in cost that you see there, coming from the commodity price increases that we had to give last year same time. And this year actually is a significant saving that is offsetting that. On the fixed cost line, we have managed to keep it extremely tight, and that is why you see it's almost entirely the depreciation and amortization that you see against it. And Forex is provident, so I won't talk about that at all. So suffice it to say that the elements of the P&L that are under our control and something that we really want to keep it tight, we have managed to keep it tight. And as far as the volume is concerned, it is fundamentally a correction that we have done to recognize the severe slowdown that we are seeing in the market today. On the cash flow slide, clearly there is the cash profit after tax this quarter has been very poor, coming from the corrections that we had done on the stock levels. The previous slide talked to that. But I'm quite happy that as a business, we are now focused squarely on cash flows. And despite cutting significant inventory across the system, managed to get receivables improved, inventory improved. The only decline that you see there on the payable side, which is more a offshoot of the correction that we're doing on the purchase side. The minute you correct that, this will come back again. That is more optics for us as we go forward. So CapEx continues apace simply because we are in the midst of a BS6 investment phase. We cannot pull it off at this point in time. We need to be there and land this plane, so that continues. But we will be calibrating our total CapEx this year by close to about 4,500 crores is what we expect to bottom out on the CapEx side compared to the 5,000 that we originally planned. So that will be a correction that we are doing as well. On the CV side, I think we called out the retails being significantly higher than wholesales. And we are now, the dealer stock levels are sitting at about 35 days, and which is broadly where we would like it to be. And we are focusing squarely on the dealer performance, their profitability, while ensuring the network expansion happens. And this ecosystem viability we had called out last quarter continues even in this quarter as well. So we've delivered that, and we now believe we are at a comfortable level as far as dealer stock levels. At the reduced retail levels is what these days are about. So the minute the turnaround happens in the market, we expect to see a pickup here as well. So we believe we are well and truly ready for a transition to BS6 by keeping our system inventory quite tight. If I go one level below on the M&HCV performance, I would like to pause a bit on this particular slide. What really has played out in this quarter and this year is that I draw your attention to the left graph on the volume growth. This is a business that typically delivers about 6 to 8% volume growth. And we have seen that doing about 16%, 12% kind of volume growth last year and this year, and the year before. And this year, actually, in the first half, so far, it has declined by 45%, which you are all well aware of. Under these conditions, what we are reassured is that our market shares continue to improve, which means we are not losing competitiveness in the market. Interestingly, the portfolio post the axle loads have actually dramatically shifted. What you see in the graph is the various tonnage points. So you have the 49 tonner to the 55 tonner, the 40 ton to the 46 ton. Just see the speed with which that has actually declined post the introduction of axle load. And all of us are aware that these are the most profitable segments in the market. And on top of it, we also have a situation on the absolute gross profits being higher on these vehicles compared to the other vehicles there. And while a smaller tonnage point like 16 tonners and 25 tonners, those have actually increased. So in this kind of a situation, we need to, it's also a structural change that we are seeing in the market. Therefore, we need to correct for that in terms of the profitability of these individual segments, as well as profitability of the other ILCV and SCV segments, which you can see those things starting to pick up as well. So believe we are focusing squarely on ensuring a competitive performance in this volatile environment from all sides, and quite confident that we will be able to pull through with this. And I'm sure Girish would want to talk about this subsequently when you're having questions as well. So that's probably what I had to say. The implications are the same thing on the respective CV and the PV portfolio as well. On the PV side, the correction on retails have been severe because we've also corrected the dealer network distribution organization, which I called out last quarter. So that annualizes as we go forward. The dealer stock levels at 48 days are high, but that is a midst of, because September is the start of the festive season, so this is at the lower retail level, these numbers are there. So as the festive season ends and we complete the BS6, BS4 transition, this will now come down to 30 days. And just as we committed on every other thing that we do, we get this done as well. It is just something we have to ensure that we don't want to lose sale in the peak of festive season. That's the reason this correction was slightly delayed on the dealer stock level. So revenue, the key thing in that, quite disappointed is the EBITDA break-even is something that we could not deliver this quarter. And that can be attributed squarely to the severe corrections that we had to take to ensure viability of the ecosystem. On top of it, we also taken the one-off write-offs that we had as well. So as far as EV is concerned, I think our action continues. We continue to be an industry leader as far as volumes are concerned for the quarter. And the product range is now starting to fill up quite rapidly. We now have the extended range Tigor that has been launched at 213 kilometers. We also have the new Zipron state-of-the-art technology on vehicle technology, which has got a series of promises in terms of what we are going to deliver, in terms of range, in terms of quality, in terms of weighting depth, the whole piece there. And we've also now started to see strong profitability improvement in this as we start understanding this technology better and better. So quite happy with the way this has progressed. And the next big event for us is the launch of the Nexon Electric. So do await that. Quite excited. Do draw your attention to the Millennium AV that's currently running out there to show how it's the first electric vehicle to go from Manali to Leh out there. Tata Motors Finance, it's been quite a change in the way that business is starting to manage itself in the midst of a severe slowdown. The disbursements are down 37%. GNPAs are up 4.9%, but I'm not concerned about it at this point in time because the GNPA is led out of, we are aware of the strategic suppliers who have had liquidity issues, and therefore those people have started to improve from September onwards. And our own collection systems were undergoing a change as we put through Project Sparkle. And Project Sparkle has now started to deliver, and we are seeing the benefits coming through in the P&L, which is again good stuff. But nothing takes away from the fact that even though we have improved market share, the disbursements are down quite significantly, reflecting the performance of the CV and the PV businesses. The big news as far as Tata Motors Finance is concerned is the plans that we are now pivoting the strategy out there to start moving to an asset-light model while fixing the total investment that we put into that business, and that will then substantially improve the ROEs going forward. More about this, as we said, as we start having the plans finalized, and we'll talk about this in the coming quarters. So on a net debt level, you have seen that the liquidity and is adequate, and the reason why we had to intervene with the preferential allotment in that is what you see in the Tata Motors standalone metrics that are there on gross debt to EBITDA. But otherwise, with this correction coming through, we are confident that this will now start coming back under control again. So overall, the market situation continues to remain challenging. You've seen this many times. I won't talk too much about it, barring the call-outs, specific call-outs that I have to do. Brexit remains a challenge. We still, you will know as much as I do in terms of what is likely to happen there. So let's wait for the good news to play out there. As far as India is concerned, the sharp slowdown is very much real, and it totally now depends on how fast industry infrastructure spending starts coming through to take up CV, and PV, of course, is more a consumer sentiment issue. But, of course, the government has given strong signals to intervene in this, and we are hoping for the best as far as this is concerned. And in this situation, how do you see the outlook? JLR, Adrian talked about it, no change in plans. We remain confident of achieving it, so I'll just leave it at that. As far as India is concerned, we remain confident on our medium to long-term plans, but the near term is fluid, and therefore we are not in a position to comment. And we will, of course, focus on retail growth, agility, and wait for as and when growth does pick up, we'll be there to ensure we tap into it. And our entire focus remains on BS6 migration, focusing on cost and cash, and working on the liquidity across the entire system. So this is what we had to say. Half an hour is up, so let me open it back to you again as Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kapil Singh from Nomura. Please go ahead.
Hello, sir. Congratulations on a great set of results. Firstly, on JLR, I wanted to check on the sustainability of the numbers. If you could give some colors, because we've seen the raw material to sales ratio, which is a gross margin, seeing a very strong improvement this quarter. So are there any one-offs to call out there? And also the other expenditure, if I see, even with revenue growing nearly 20%, it's been largely flat. So if you could just help us understand that first.
Adrian, I guess you can make it, but we also have highlighted it in our press statement. Adrian?
Yeah, okay. Yes, I will do. Yeah. So sustainability, as you mentioned, we had a really nice quarter at 4.8% EBIT margin. We do expect to be profitable in the second half of the year. We do expect volumes to actually rise also in the second half of the year. Second half of the year is a better selling season for us. And we have this huge thing called Brexit still out there, which of course still has not been resolved. And I'm sure you're aware also that we will close our plants again in 2 weeks' time for a whole week, losing 12,000 units of production. That certainly will impact us in the short term, including quarter two. When we actually asked the question last quarter one, it was at least 100 million problem for us in that quarter. It's likely to be similar this quarter. However, we also expect over the balance of the year to trade through that, and so long as we don't have another attempt to do Brexit at the end of January, which gives us a problem in February, I expect us to be able to trade through the issues that Brexit provides, assuming there is not a hard Brexit, of course. So cautiously optimistic. The underlying trading results are getting better in very difficult market circumstances, but we've got the B word out there, which of course could actually impact that in the second half yet.
Sorry, my question was on the specific line items, the gross margins and the other expenditure for the quarter, which we have seen a very strong improvement as a percentage of sales. So anything to call out there, or these are sustainable? Because there's almost 200 bps plus improvement on the gross margins, and similarly for the other expenditure, it's actually down from 1Q and last year.
Well, it's back into the presentation, right? So we had a nice mix. We had higher Range Rovers SUV products, which is obviously important to us. So 8% revenue growth with 2.9% volume increase tells you that was a good, healthy mix for us in the quarter. Parts and accessories were also higher in the quarter, and then the increases in the actual EBIT performance through charges coming through. In terms of a care point within the data, the VME levels, which again were stubbornly higher at 7%. But apart from that, pretty every line that part of gross margin was positive for us versus the prior quarter data.
Okay, thank you. And secondly, I just wanted to check one question I had from the Tata Motors Group results data bank for Q2 FY20. I see that on slide number 10, we have a realized forex exchange gain of 509 crores, and the standalone number is 20 crores. So where is the balance realized forex exchange gain sitting?
Is Kapil Somaya here. It is mainly sitting in Tata Motors realized gain. So we had cancelled some of the hedges on the ECB, and in Q2 we have seen a realized gain of 144 crores, which is there. The balance it at the JLR level. I could request Ben to chip in.
Thank you. The next question is from the line of Robin Zhu from Bernstein. Please go ahead.
Hi, thank you. So I had three questions, please, if possible. The first one is the impact of FX. I mean, one thing that's quite noticeable is the pound dollar was 1.23 in the second quarter, which is quite a bit lower on a sequential basis. It's since gone back up again. Could you just clarify, to what extent did FX impact revenue and direct material costs, and what the margin of that, the sort of direct margin move sequentially would have been had we had a constant FX environment from Q1 to Q2. The second question is on the China JV. I mean, the equity income number continues to look very weak. One of the things that I think is a bit of an issue is the fact that there's too much capacity. That's obviously on your books. I mean, just if you could share any thoughts on what the strategic plan there might be to try and lower those losses over time, or is it just going to remain large so long as your volumes remain, vaguely where they are today? Question three is more just accounting. I think it was mentioned that you had a 65 million euro subsidy. Just keen to know where that was booked and what that was in pounds. Thank you.
All righty. Let me take those in the order that you asked them. So FX. If you go back into the actual waterfall chart, you'll see us breaking that out. So we definitely had some good operating exchange in the quarter. I think the number was 78 million, and of course that's directly as a result the net effect of sterling actually being closer to that 123. and that 112 level on the euro. So that was positive operating net income statement in the quarter. We did have some hedges, of course. You know, our hedge book is rolling off, and there is some backup in the paper on the roll-off of those hedges. But, of course, you know, as the sterling actually depreciates and the contract values increase, we had a large balance revaluation, obviously moving from 127, I think it was the end of June, to about 123, which hit us on that FX reval line on that page. You'll see about 28 million. And we had some unrealized commodities. So net, the operating exchange was very positive. The hedges crystallized, were neutralizing out, and it was the balance sheet revaluation at the end of September. That was the partial offset. If you now move forward to 129, obviously, which we're currently at 128 this morning, you know, the revaluation on the balance sheet reverses. On the China JV... On the China JV question, it was a difficult quarter for us. We did say we were going to stimulate the sales on the JV. We've done that for several reasons, actually. One, because the selling rate was just too low. But also, two, there's a huge refresh of the products in the marketplace for the JV over the course of the next 6 to 9 months, the first one of which, the Evoque, did start to sell quarter 2. And we are going to see an uptick in the sales rate and an improvement, we believe, in the transacting prices on all 4 of those products as we go through the next 6 to 9 months. Evoque is the first one up. The XE Long was the second one. And then the Discovery Sport will be the third one that comes along. So we are expecting some improvements in the transacting prices, although it is a difficult marketplace for us, and there is certainly still work in progress. I'd expect us to be able to report some positives from that work when we talk in January. And the third one is the grant received from Nitra that gets put to the balance sheet. Obviously, it impacts cash and improves cash by 65 million euros in the quarter. It goes through to the balance sheet. And we think in the quarter it probably had a favorable income statement impact of about 5 million.
Right, got it. If I could just follow up, please, on the China JV. Has the company given any thought to, you know, potentially writing down some of the assets like you did a few quarters ago? Is that even possible, considering that it's a 50-50 arrangement? Because otherwise you just have this big lump of fixed assets that's just going to weigh on the DNA line of the JV.
Yeah, we look at it each quarter, Robin, actually. I think what we're actually doing at the moment is being clearer exactly where we think the trading performance is going to be over the next 12 months and then the planning period. That normally is the trigger for whether we feel we need to write down those assets. If we continue to trade as we have in the last quarter going forward, there would be an asset write-down, but I think I'm signaling we don't expect to trade quite that way over the following 12 months.
Got it. Thank you.
Thank you. The next question is from the line of Sonal Gupta from UBS. Please go ahead.
Yeah, hi. Good evening. Thanks for taking my questions. A couple of questions. One on the JLR residual reserve of about 25 million this quarter. My understanding was that, like in terms of you were not on the hook for some of these residuals on the lease book, but is there, are you on the, because right now we don't really have much liability in the balance sheet, but is there can there be a liability from these agreements for other following model years?
Okay, so yes, it was North American business. It was on 16 model year vehicles for Range Rover Sport and Range Rover. Prior contracts with Chase was a sharing 50-50 losses over 6.5% reduction, I think. We've changed those contracts since 16 model year, so we don't expect any sizable increases on RV losses on our vehicles in the U.S. over the following periods. Where we're trading at the moment, we're pretty much done, we feel. So there is a sharing arrangement, that's the key point, over a certain amount of losses. Overwhelmingly, all 100% before that is actually taken by Chase.
Okay. And could you give us a sense of where your warranty cost was in this quarter compared to Q1 for JLR?
Yeah. In Q1, warranty cost was 6%. If you remember back to Q1, we had 2 or 3 significant one-offs. One was the TDV6 recall. Another one was this Goodwill program software over the air, which we actually pull into the marketplace, and we're rolling out over the course of this next 3 to 6 months. In Q2, there was a significant reduction in warranty as a percentage of revenue to just over 4%, so it improved by 2 points. Most of that improvement because we didn't have one-offs.
Okay.
The underlying rate on the most of our vehicles, as a coverage level of warranty, is broadly the same as Q1 levels.
So should we see 4% as a more sustainable level? I mean, given that there are no one-offs in this? I
think I said in July, the range for us will be between 4 and 6%. So between the 4 and 6%, yes. Without one-offs, I would expect it to be closer to 4%.
Right. And just lastly, on the China volume outlook for JLR, I mean, we have seen an improvement, of course, but we're coming off a very low base as well. So, I mean, just in terms of absolute volumes, do you think sequentially how things could pan out? I mean, do you see significant improvement from current volume levels, or do you think we'll see more gradual improvement from here?
We'll see a gradual improvement from the levels we just delivered in Q2, but we do expect them to be positive in the second half of the year versus that level.
Sure. Thanks a lot. Thanks.
Thank you.
Thank you. The next question is from the line of Gunjan Prithyani from JP Morgan. Please go ahead.
Yeah, hi. Thanks for taking my questions. I had just this follow-up on the China thing. Now, at this level of volumes, the EBIT margin is still very, very negative. So how should we look at it? I mean, if the volumes were to improve only gradually, do you see the margin trajectory improving, or we continue to see that this business will have a big loss for full year?
Let me just check. I think you're talking about the JV rather than the import business.
Yes, the CJLR.
I think so. There will be a gradual improvement. I think the big point to note, though, of course, is that there are 4 of the model lines are actually pretty much on run out or just being changed, and therefore you are seeing the impact of older vehicles at the end of their current life. And so I will expect, even at these levels of volumes, for transacting prices to lift and for the losses in the JV to reduce substantially from the levels you've seen here in Q2.
Okay. Any guidance you can give as to how should we see this trajectory improving? I mean, do we see this turning positive anytime soon, or this stays negative, until we really see the mix in terms of new products coming through?
You'll see. I mean, the new products are starting to come through. The Evoque was the first one through in Q2. That started selling, I think, in August. The XE Long starts to sell later in this quarter, in December, I believe. So you will have to wait for those new products to come along. I think the important point is they are either here or very close to being here. And the job, obviously, with the old product is to make sure you run them out quickly and orderly, and that's what you're seeing in some of the data that we posted within Q2.
Okay. And the second question I had was on the capital raise. Now, this is entirely going to be used for standalone operations, as I understand. Is there any thought process to look at, to think about, looking at the funding gap at JLR? Because clearly your own guidance is that it stays negative for 2 years. And, what is the thought process that is there going to be any infusion to bridge the funding gap there?
Let me take that. I think, first of all, to put this in context, I think this is first intervention happening to correct the group's overall debt levels and bring it down. That is one. The other piece is also a strong signal to support from a promoter to support the business in terms of how they see this as an opportunity. You will also notice that it's done at a premium to the current market price. And therefore, this is being done to actually signal as much as we fund. That is one. Number 2, as far as the usage of these funds is concerned, these will be used to repay debt. And the way the ratings work is JLR folds up into Tata Motors total, and that's how the ratings work. And therefore, we are now intervening at a group level to get the rating support going, and it will benefit JLR and its bondholders as well. So therefore, at this point in time, this is used to pay down group debt, and the usage can be in Tata Motors, it could be in JLR, it could be anywhere. And totally, we run it as a complete group when it comes to how we want to manage the net debt overall. That's how the rating companies looked at it as well. So that's how we are looking at it. And at this point in time, the debt reduction will happen in the standalone entity because it is facing this maximum challenge at this point in time. As far as JLR is concerned, it's a very strong balance sheet, as I keep reiterating again and again. Their debt equity ratios are quite comfortable. Their gross debt EBITDA numbers are also quite comfortable, particularly with this performance also starting to turn. And therefore, we'll watch this space closely. The sign of the promoter is to say that we believe in Tata Motors, and that's how this intervention is coming in.
Okay, got it. Just last question, if I can squeeze in on the alliance with BMW, and we've also spoken about looking at such more alliances. Could you, throw some more light on it? I mean, what kind of alliances we are looking at, and does that mean that there is a case for capex to be lower from where we are currently at JLR?
Overall, I can only really share your opinion. We are looking for technological partnerships like BMW, but we also have by far partnerships in more areas. Think about the partnerships with Waymo, think about the partnerships in China with Alibaba or Baidu, where we really are also in the IT area. Or think about, we also have a lot of support by TCS in going forward in the IT sector. This is very important because no company can really be perfect and leading in every and each segment.
Okay, got it. Thank you.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Securities Limited. Please go ahead.
Hi, sir. My first question pertains to JLR. In fact, a couple of questions for JLR. One is on the material cost reduction, which you have highlighted in the presentation of £300 million. How much of that has been achieved in first half? And second question pertains to JLR tax rate in this quarter. Any reason for tax rate to be so high in second quarter?
Okay, let me take the first question you asked. I think you're probably, when you say the 300 million, you're probably referring to the charge page. That didn't actually all happen within quarter two, of course. If you go to the waterfall bridge, you'll see in quarter two there was about a £40 million, I think, improvement in material costs, even though there's some commodity costs in there as well. So what we're signaling there is, we as a part of the charge program, we're expecting in a full year to actually reduce material by about £300 million. From a tax rate perspective, can you just repeat your question again, if you would?
So if you look at the effective tax rate for JLR in this quarter, it's almost close to 36%. I know it's not the right way to look at it because of the addition of taxes and PBT losses at some of the entities. But what would be the sustainable tax rate for the full year?
Can I come in here? I think what will be important, the effective tax rates do look for a full year number. These are volatile numbers. Full year JLR tax rate, nothing has changed from what it has been done over the previous years. What you see is a console where you see the tax number also being extremely high is basically profits in JLR being taxed at normative rates. Losses in Tata Motors, deferred tax asset not recognized, and that combination just swings this number overall. So ETR is always better to be looked at on a full year basis, and we do not see any change as far as JLR ETR rates are concerned.
Should that be around 25-26% or higher?
20 to 25%, 22% typically they're on that.
Okay, right. And the third question pertains to India business, particularly on the CV side. What are the trends we are seeing now after last quarter of, while we corrected inventory, but retails were still substantially down for commercial vehicle business. So if Mr. Vak can highlight about what are the emerging trends on the M&HCV business and LCV business and outlook for second half?
Yeah. Okay, so I think the last quarter was pretty bad, as you can see, and in fact, the total industry volume in September was the lowest in a September over past 10 years. I mean, that was the kind of savage fall one has seen. And if you look forward, it's very difficult to project what kind of growth or degrowth is likely to happen. But one is seeing some green shoots in the demand driver, not demand, so to say, but there are some green shoots in the demand driver. Some of which are like the freight availability post monsoon is looking up slightly. The freight rates are firming up slightly. And, we look at what we call as a transporters sentiment index, which actually is an indication of their satisfaction with the current business and their likelihood of purchase going ahead. And what we've seen is this, for the cargo trucks, the transporters sentiment index actually bottomed out in Q1 and has slightly moved up in Q2, which augurs well for cargo. But if you look at tipper, the sentiment index, in fact, has further gone down in Q2 over Q1. So that's the mix that one sees in medium and heavy commercial vehicles. I think post the relief package by the government, one has started seeing some selective fund disbursement happening on the infrastructure projects, which will gradually get things moving. We are awaiting start of some of the new projects and allocation of new projects, giving of some mining licenses also. So therefore, I think there are some green shoots on demand drivers. If you look at the fleet operators as such, and more or less I'm talking about medium and heavy commercial vehicles, they have actually started coming forward and inquiring about the things because it makes a lot of business sense for them to buy the BS4 vehicles now by replacing their 5, 7, 10-year-old BS2, BS3 vehicles, because there's a huge operating cost advantage when one moves to BS4 vehicles, and they can also avoid the likely price increase which is going to happen in BS6. So that's what we see in medium and heavy commercial vehicles. Right now in this month, we still don't see green shoots in demand, but we very clearly see green shoots in demand drivers, so something positive may pan out as we go ahead. If you look at the remaining segments, intermediate and light commercial vehicles actually has been the one which has dropped the minimum amongst all the segments, and this actually continues to do well. Drop is less as compared to other ones, and that's how it is going ahead. And we see more customers coming here and asking about new vehicles, the BS4 vehicles, before we get into BS6. I think small commercial vehicles, currently the festive season is there, and therefore we do see the annual increase in the retail. But we'll have to wait as to how the small commercial vehicles pan out as we go ahead.
Sure. Thanks for this detailed reply. I'll come back in queue.
Thank you. The next question is from the line of Vinay Singh from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. Just firstly on China, most of the press releases of JLR are pointing out as China recovery being the key driver for profits turning. So is that coming from the import business? Because clearly in the JV business we've not seen any improvement. So is the wholesale dispatches to China sequentially up very sharply, and or the pricing recovery happening over there? So just to understand that, which part of China has seen recovery?
Yeah, it is the import business, as you quite rightly say. It is having an impact in quarter two, modest impact, but it is having an impact in quarter two. And we will look to, as I mentioned earlier, build the value from our China import business steadily as we go through the balance of this fiscal year.
Okay, so the retail dispatches to China are up only 1,500 units quarter to quarter. So it means wholesale must have gone up significantly. So inventory levels in China would have gone up. Is that correct?
No. That's certainly not correct. I showed you the China page. You can see inventory levels.
Okay.
They're not going up.
So just, so it's a little surprising that just 1,500 units would make such a big difference. But secondly, coming to Project Charge, we were targeting 0.8 million.
Vinay, can I intervene for a minute here? I think if you see the waterfall slide on the EBIT improvement, you will notice that it is a pretty well-rounded delivery coming in from JLR on its performance. I wouldn't attribute this only to China, And yes, there is a better mix coming in because Land Rover sold better than Jaguar. Charge is delivered. There is a substantial pieces of the puzzle that have come in the right way this quarter. So therefore, definitely one of them. Important, but not the only thing out there. Yeah.
Right. No, that's helpful. Just on the project charge, you are targeting around 0.8 billion cost savings on the cost front. How much have we achieved in H1, and are we tracked to do 800 million pounds for the whole year?
Yes, so it's that 500 million delivered so far under the charge program. 150 million of that was last fiscal year, which means 350 million of that is the first half of this year.
No, so we are on track to do the remaining 450 H2.
And the difference is in the second half of the year, more than material cost reductions as negotiations get closed down and backdated. More than material cost reductions do come through in the second half of the year. So yes, we're on track.
Right. And just one question on the India business, one on CV and one on PV. On the CV side, we've seen discounts are going up quite sharply in the last quarter. So when inventory pressures are eased down, do we expect discounts to ease down over there? And the question on PV is that, market share has come down on the wholesale side quite sharply. So could you share some insights on retail market share?
Yeah. Let me come in here. As far as CV discounting is concerned, you're right. The intensity of discounting in the market is indeed high. And I think to your question on how does it play out going forward, we are happy that our inventory levels have corrected to almost normative levels that we want it to be. But the levels of market discounting will totally depend on how each of the players' inventory levels are, which we are not privy to, so we'll have to just wait and see how it plays out. Suffice it to say that from our point of view, we'll remain competitive to ensure that we do not lose market share. Girish, would you want to amplify that?
Yeah. So what I would also add is that I think our stocks are now at a 6-quarter low, and the demand-supply mismatch, which was there in Q2, more towards supply being more than demand, is getting normated, as Balaji said, and I think this, with some green shoots on demand drivers, I think one will see the realizations firming up as we go ahead.
Then as far as PV market share is concerned, it's a conscious correction in the wholesale market share that you have. Let me hand it over to Gunther to clarify on anything else.
Yeah, as I have already rightfully mentioned, that the market share came down on wholesale as it is officially and somewhat uniquely measured in India. We took a conscious call in preparation of transition BS4 to BS6, and because of the fact that the market literally collapsed in the second quarter, where there was in particular an expectation that GST rates might get reduced. And the GST Council had its meeting the 1st of the 20th of September. We decided to drastically cut production. With the cut of production, we also adjusted wholesale accordingly, and since we have anyway shifted focus from previously wholesale to retail as of the 1st of April this year, we took the conscious impact on our market share, dropping below 5%. But for us, it was much more important to reduce the stock level. It was much more important to actually stick to our commitment towards the dealer network, to reduce the stock level and to unleash working capital on their side. Because as far as the retail was concerned, and you have seen on one of the slides presented by Balaji that our retail was significantly higher than wholesale as the result of the effort to reduce the stock. On retail, although there is no official statistic available in India that would officially confirm it, although we are pushing hard, even with SIAM and AFADA, which is the association representing the dealer, to actually focus on the ground reality as it is retail. And there we have not seen any compromise, any drop in our market share, which was during the first half of the year consistently between 6 to 7%. Which has actually confirmed to us that we are doing the right thing. This was the headline of Balaji's presentation, in order to correct the market situation and to adjust the system stock, as we call it. So not only on the dealers, also on Tata Motors side, to the best possible extent. And by the end of the month, as we look forward, end of the month of October, we expect to be back to the normal level. Which gives us the comfort for transition BS4 to BS6.
Great. And the 6 to 7% is overall PV retail market share. That's your best estimate, right?
That's what we see on what we can read from the statistics available and what we can read from the market's feedback.
But when I just keep an estimate, this is estimate because we have no idea of knowing the retail share, retail growth of verifiable numbers, but basis what is the market intelligence, we believe it's around 6% at this, in the quarter ended.
Great. Thanks a lot. Thank you.
Thank you. The next question is from the line of Chirag Shah from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity. Sir, two housekeeping questions first. In India business, this 233 crore charge on the PV business that you have taken, where has it been accounted for?
It's inside the EBITDA line. Other expenses, as you see that.
It's in that line. And
other
second question is for, second is to Girish. One, your comment on shift to lower tonnage, which is there in the presentation. Is it more prevalent due to the slowdown that we are seeing, or it is more due to Excel norms, which is a bigger reason, because both have coincided at the same time? So what gives you confidence to attribute more to Excel norms rather than slowdown?
Yeah, so see, the slowdown which has happened, Chirag, is also different in different end-use segments, right? These 2XL and 3XL trucks, and especially those in long wheelbase segments, are mostly used for the e-commerce segment, right? That is for logistics of e-commerce companies. And this is one segment which has been growing pretty well. And therefore, one sees that share of this segment has actually gone up as compared to the multi-axle vehicles and tractor-trailers. The multi-axle vehicles, tractor-trailers, which are used for cement, steel transportation, or some of them are used in road construction for raw material transportation, I think those segments end-use segments have gone down. And as a result, the fall in these segments is actually higher than the overall industry volume fall. That's the reason that the smaller tonnage vehicles have gone up. So as we go ahead, depending upon how one sees the end-use segments growing in the remaining half, the second half of the year, I think different segments will kind of change their contour in the overall industry volume.
Yeah, this is helpful. And question on JLR. One, when I look at your EBITDA per vehicle as a metric, we have the best EBITDA per vehicle since 2Q FY16. So how do we look at this number? Because EBITDA per vehicle, can it improve further from here on, or there are certain business pressures which could come in for us? I understand that the current performance is driven by new launches. So the sustainability of new launch and its impact on profitability, if you can help us understand.
Let me take that question, if you may. We had a really good EBIT and EBITDA in quarter two. I think this back into the answer I gave earlier in terms of the second half of the year. I do expect volumes to be stronger in the second half of the year. Maybe because of the volume high, there'll be a little bit of a weakening in the mix. So on a per unit basis, we won't quite get the same level of profitability. There is the big issue called Brexit coming at us in Q3 again, which will impact. We're only building 120,000 cars in the quarter. That will certainly have an impact on the quarterly results. So I would encourage you to wait to see what the shape of the quarter is when we talk in January. However, the underlying profitability on the vehicles are stronger than they were earlier in the year, and I'll go back to quarter one to help you understand that. In quarter one, we had a VME of 9% of GVR. That was down to 7% in quarter two, and I expect that level going forward this fiscal year. And in quarter one, we had a warranty of more than 6% of GVR, and that's down to 4% in quarter two, and I'm expecting a level closer to 4% in the second half of the year. So there's basically a 4-point improvement in those two areas in quarter two, and it's that level of spend and coverages I expect in the second half of the year.
Chirag, I think just to close that point, I think that is the reason we are confirming that we hold our full year plans that is between 3 to 4% EBIT. And all the interventions that we are making is to ensure that we get more and more robust in terms of delivering within that particular corridor. And we'll reconfirm how we are performing against it in every quarter as we go forward.
Yeah, thank you and all the best.
Thanks.
question is from the line of Alexianis from BlackRock Capital. Please go ahead.
Thank you for taking my question. This is a more JLR-focused question. What are your plans regarding potentially accessing the bond market? And if so, what are your thoughts about whether secured versus unsecured financing would be more likely?
I'll take that. So this is Ben Burkar, I'm the treasurer at JLR. So in terms of accessing the bond market, one of the slides in the JLR presentation shows what we've done to date in terms of funding, and that we will be looking at other funding options for the rest of the year. And one of the things noted there is definitely looking at bonds. We will continue to do the same thing we always do, which is monitor the bond market and decide when the right time to access it is. We'll obviously be taking a look at the market after it absorbs these results, and we'll look at whether it would make sense to go sometime yet this year, or maybe we wait until next year. So I think at this point that still remains to be decided. In terms of the question of security, we've been very, very clear that we have no plans to issue secured debt. Our strategy has always been around funding on an unsecured basis, and there is no change to that strategy.
I see. Thank you very much.
The next question is from the line of Raghunandan from Emkay Global. Please go ahead.
Thank you, sir, for the opportunity. Congratulations on a very good set of results. My first question was on JLR. If I look at the market share between April to September in various geographies, there has been a reduction in market share. When I calculate market share, I'm taking the top 4-5 players and seeing how the market share has changed for JLR. So just wanted to understand, how do you see the strategy to recover this share going forward?
Okay, let me go on, Ralph. Yours.
Yeah. At the end of the day, I'm not interested that we sell more cars, but we sell profitable cars. Market share is important for us on a totally different level, and quite clear we want to sell even more cars, and this ambition is all over the place. We have let's say, critical items in the one or the other country because of legislation and regulatory issues, especially in overseas. But in the rest of the markets, we see a stable area. Issue is, but also now the UK, where we see that customers hold back because of this kind of Brexit debate. US is more or less stable, and we will continue, and we will have a stronger third and fourth quarter.
Thank you, sir. My second question was to Girish. There has been a lot of news on the scrappage policy of late, so just wanted to understand how you see that and what are your thoughts about it.
So, 2-3 things on the scrappage policy. First of all, for it to make any meaningful difference on the demand, the life of the vehicle should be, somewhere 10 years. I mean, right now, initially there was a talk of 20 years, and there was a talk of 15 years. I think if the period is made anywhere between 10 to 15 years, then it would be helpful. And if it goes more towards 10 years, then I think it will have a good impact on demand. Number one. Number two, I think the policy is yet to be fully fleshed out in terms of definition of what is end of life. Right? So end of life need not necessarily be by number of years, but it can also be in terms of usage, the number of kilometers it has run, and so on and so forth. So there is also need to flesh out the policy better so that it actually ends up into defining the end of life properly. And third thing is, after the end of life has also been decided, there is a need for good number of scrappage facilities across the country. Because this is something cannot be localized at one location with high capacity the way cars or vehicles are made. So this is another requirement which is there. And on the scrappage facilities, organized scrappage facilities, I think things have just started moving. So all these three things need to fall in place, either in terms of clarity or in terms of capacity, and then one can see a good impact happening on demand. But as a CV OEM, one would certainly look at this coming in when there is a transition to BS6, but this will certainly lead to a good incentive for people to come forward and buy new vehicles.
Thank you, sir. That was helpful. One last question, if I may. How was the festive season on the car side?
I'm going to take this question. Festive season is not yet over, but allow me in the first instance to remark on the month of September. Month of September, as mentioned already earlier, up to the 20th of September, the GST Council meeting, there was literally not too much of a festive season visible. We have hardly seen any improvement on the inquiries, and certainly not on conversion in retail, because people expected a movement on GST. While the situation actually changed as of the 21st of September, where we saw in the last week of the month of September significant increase in inquiries, and also a good improvement on the conversion. Retail was still somewhat below because lots of Indian customers preferred to actually take the vehicles physically in the month of October for a kind of a different reason. In the month of October, as we speak, we have seen a continuation of the positive trend. As far as the inquiry level is concerned, the inquiries were almost on the level of what we had seen a year ago in the same festive season. The only thing which we have seen is a continuous trend of a change in the mix of the inquiries from what we call the natural walk-ins and the tele-inquiries more to digital inquiries, digital leads, where I think overall in the industry it's a matter of fact that although the number of inquiries is higher, the conversion rate on the digital leads is not close yet to what we are used to from the natural inquiries and the walk-in. But this is something Tata Motors has addressed. As far as our digital follow-up on the digital leads is concerned, dedicated the digital lead teams got established with most of our dealers, because it's a particular skill set required to analyze the leads, to talk to the customers, and to finally offer them a test drive where we need to match the digital lead with the physical reality of our business. As far as conversion rate is concerned, conversion rate in general has improved. In the month of October, the retail has picked up, and so therefore we expect a significantly better month than the month of September. But I make the same caveat like Girish. This is a festive season where all of the players have actually put their best foot forward as far as the festive season offerings are concerned. This is certainly not going to continue in the quarter till the end of the year. So let's actually see that as we get out of the festive season and we actually get back to business as usual, how strong the demand situation is going to be. We expect in line with the normal seasonality that November is most probably going to be somewhat on a lower level, but towards the end of the year, as far as the calendar year change is concerned, we expect that retail is going to increase, which would give us actually the best starting point for the transition BS4 to BS6, because as of the next quarter, we are going to introduce the BS6 vehicles in preparation of the transition effective as of the 1st of April 2020.
Thank you, sir. Thank you for the detailed answer. That was very helpful.
Thank you. The next question is from the line of Rahul Doshi from Pinpoint Asset Management. Please go ahead.
Hello, sir. This is Rahul Doshi. Congratulations on the good set of numbers. Just one question. When Mr. Balaji in the opening remarks said that the government is contemplating more measures in terms of boosting demand, what exactly are we guys referring to, as in some color in terms of the steps that are being taken, apart from the scrappage which is already being discussed?
Yeah, I think the combination of factors, if you recollect the conversation over the last 1.5 months out there in the public domain, I think the big one is the infrastructure investment that the government is key to front end, and that will effectively have a significant impact on the construct segment for us and of course the spin-off effects thereafter. Then of course the interventions happening on payments and liquidity is getting infused in the system. And that is again will be a big area for us to actually see the unlock of demand. So we are already seeing some of the NHAI projects starting to come back again. Those then start generating demand. So I think it is, and then of course the entire cycle of the multiplier effect of all these things coming through in the rest of the economy as well. So we remain cautiously optimistic that these are things that should start benefiting us going forward. Then on top of it is scrappage. Then of course when the sentiment changes, is there a bonanza of a BS6 pre-buy, BS4 pre-buy? Those things we'll have to wait and see.
So what according to you is a rational time frame in terms of expecting a demand improvement apart from the scrappage? Let's say scrappage is not announced. What according to you would be the time frame over which you'll see the demand getting back to normalcy?
I think it's your guess is as good as mine. Earlier the better, which is the reason we left this thing outlook as the near term is fluid. So I think more than waiting for demand to come our way, our objective is to say that remain as agile and as nimble as possible so that when the demand does pick up, we are able to jump onto it immediately. So that is our entire focus at this point in time.
Thanks a lot, sir.
Thanks.
Thank you. The next question is from the line of Priya Ranjan from Antique Stock Broking. Please go ahead.
Yeah, thanks for taking my question. One question is on the material cost reduction on the JLR side. You have talked about 400 million. So where do you see, I mean, what are the scopes in terms of where do you see the reduction can happen? The second part is on the warranty cost. I mean, you have talked about that there is a 2% reduction, but when we look at the call out in the waterfall chart, it's saying around 5 million pound of negative impact of warranty cost even in this quarter compared to last year.
Let me take the first question first. So material costs, we are expecting up to £300 million reductions on a full year basis compared to prior year. Quarter by quarter, of course, as more negotiations get closed down and the claims mostly get backdated to the start of the fiscal year, the number each quarter grows. The net number in Q2 was 40 million. It will be bigger than that in quarter 3, and it will be biggest in quarter 4 as the final negotiations get closed down and backdated through back to April 2019. So we're relatively confident that the material numbers on a full year basis in charge will be delivered, and you can see what we actually did in quarter 2. On warranty cost, I think there's a clarification there. When I answered the question earlier, I was answering versus the level of spend in quarter 1 20 fiscal year, which was just over 6%. It was a part of the losses that we talked to you about in July for quarter 1. The level in quarter 2 is just over 4%. Now, the page you're referring to here is nothing to do with quarter 1. It's actually the same quarter last year, i.e. quarter 2 FY19, and the absolute level was about the same, or 5 million less. So it's a clarification around which quarter you're comparing to.
Yeah, I got it. I mean, but I mean, the warranty cost each and every quarter it has been going up. So I mean, is there any end to it, or it's, I mean, if the top line keeps growing, I mean the number of vehicles, etc., will keep increasing. So will it be increasing? I mean, what are we doing to change that? I mean, the entire direction. Percentage of to sales looks nice, but I mean, in terms of absolute number, if it can be reduced, then that will be really.
Yeah, we're working hard to reduce the absolute number. If you're on the calls in July, you'll remember our quality director, Nigel Blenkinsop, basically talked to 15 minutes of this is what we're doing about it. The quarter 1 was specific recall and goodwill actions. So the absolute number will increase as our volumes increase, and therefore the warranty car park out there gets bigger. But obviously 4% of revenue isn't acceptable, and we're working hard to reduce that, mostly in the powertrain and the infotainment areas. That's where the higher levels of warranty challenge are that we have on the vehicles.
And one thing on the write-downs, I mean, do we need to take the write-downs for engine plants sometimes in future as well with more, I mean, the diesel engine plants, etc., which we have set up in the UK?
So
let me come in here on this one. I think if you recollect the conversations on when we did the impairment, I think we have put our best foot forward in terms of what we think is an assessment of the risks that we see on this. So at this time, we don't see anything further that's coming up in front of us. So,
yeah. And second part is on India business. I mean, what kind, I mean, in terms of PV business, I mean, wholesale and retail, I mean, you have now been connecting, but the problem might have been occurring since last 1 year. So how much do you attribute to the bill but not delivered kind of scenario, which is very normal practice in the industry? I mean, typically when your Concall has faced some kind of issue in the recent past. So how do you see that?
I think from a retail perspective, the focus on retail is ensure that we keep a front end clean and ensure that it's done in the right manner. And that's where our focus remains. And as far as measures on how do we ensure that the wholesale reflect those retails and don't get ahead of themselves, that is a correction that we've been putting in place. So therefore, we believe we are in the right place on that one. And that's how we intend to take it forward.
And last one from Greece, I mean, how do you see this in the entire decline? How much do you attribute to the entire construction, etc.? I mean, the construct segment going down in the last 6 months or so? Because I guess the last year entire MSCV volume was driven by construct or the tippers, etc. Primarily driven by tippers. So.
Yes, that's right. So within the MSCV drop which has happened, which is almost around 45% in H1, I think the tipper segment has contracted more. And as I mentioned in the beginning, even the sentiment index for tipper customers is actually going down, continuously going down. And in Q2 was even lower than that of Q1, whereas in cargo, the sentiment index has increased, which means that, they are looking forward for buying possibly ahead. In tippers, as I said, what's going to help start the buying season again is actual funds disbursement from the government for various projects, number one. Number two, expediting licensing of some of the new infrastructure projects. And third is also renewing or new mining licenses to be expedited. I think these things will kind of bring back the demand for tipper. But with the government's focus on infrastructure and the amount that they have indicated they will invest in infrastructure, I think one does see in medium to long term that tippers should do very well.
And one, little longer term question, if I can, is on the, impact of DFC. There has been a lot of talk about DFC impact on the commercial vehicle side, at least on the Delhi-Mumbai corridors. So how do you say, and what's your reading on that?
Yeah, so see, there are two corridors. One is northeast and the second one is northwest. The northeast corridor, when dedicated freight corridor, when it comes up, will be used mainly for transportation of minerals, right? Minerals and coal, etc. And actually, to a great extent, these commodities are anyway being transported by rail freight. Because that's the best means of transportation for these. Therefore, the impact of the eastern corridor is going to be muted. If you look at the western corridor, which is Delhi-Mumbai, I think there is a lot of container traffic related to export-import, which happens on this corridor. And therefore, there is likely to be some impact happening on the tractor-trailer market, which uses these containers for transportation. So one does see some impact happening on the tractor-trailer market in the western corridor. But even there, I think the impact is not going to be huge, more than, maximum it would be around single-digit shift happening back from roadways to railways.
And lastly, if I can, just on the PV side, and there has been a lot of talk or debate on the diesel petrol for BS6, and there has been a lot of cost differential, etc. So what's your thought, on that front? Because market leaders is trying to move out of diesel, so your strategy on that?
We have taken an official position on it, as you might recall, saying diesel for the time being is a valid proposition for certain use cases, in particular as far as higher mileage, accumulated mileages per annum are concerned. But we expect that even for these use cases, petrol becomes an option on the pure comparison on TCO, taking the higher acquisition costs of the diesel after BS6 into consideration. This whole discussion is certainly going to be further accelerated when we look 2 years forward, 1st of April 2022, the CAFE norm phase 2, because there we need to become even more stringent, which requires an additional piece of technology to be added, where we expected in particular the low diesel displacements. That's largely the discussion, will become even more expensive. So that even borderline use cases today, which was justify a diesel engine, actually might not make the TCO calculation. So therefore, we have decided to continue with diesel. We do see these use cases, although we expect a lower percentage of diesel after transition to BS6. Talking about low displacements, larger displacements, I make reference to our 2-liter diesel, for example, on the Heavium. This kind of displacement side is going to continue because there's, honestly speaking, no real option available as far as petrol is concerned for this class of vehicle, because the 4.6 meter SUV is best equipped with diesel engine and gives the customer the best driving pleasure in terms of power and convenience. But we will very carefully monitor the situation at the lower end and will take our decisions accordingly. But for the time being, we're going to move forward as just described.
Thank you. That's all from my side.
Thank you. We take the last question, which is from the line of Stephanie from JP Morgan. Please go ahead.
Hi. You've answered most of my questions, so thank you very much for going through it. Just one quick question about the emission mandates that are coming through starting in 2020. Just wondering what your view is. We have seen some articles about, for example, perhaps some of the heavier vehicles being pushed, I guess, towards year-end and the start of next year as the mix needs to change for most of the automotive OEMs, and I didn't know if you could perhaps comment on that. And just as well, looking at the sustainability of the cost-cutting exercises that you've done. You may have already said on the call, so I apologize to repeat yourself. How are you looking at that also in the context of like raw materials as we move through the back half of the year?
Yeah, let me just clarify your question first. Are you referring to the BS6 migration in India or the emission norms in Europe?
For JLR, the European Union.
Okay, fair enough. Yeah. Adrian, would you want to begin up?
So the line for JLR team is disconnected, trying to call them back.
Okay, fair enough. So let me comment on the materials cost piece and the sustainability of the profit improvement there. If you notice that Adrian did talk about that in terms of why we believe that some of the number corrections that have happened are sustainable, particularly from the point of view of warranty cost decreases, as well as some of the charge interventions coming the way we want it to play. And, of course, the benefit of the overall volume starting to pick up. The fly in the ointment, of course, is Brexit. We just need to wait and see how that plays out in the coming months, and that could spoil the picture if we are forced into one more round of stock correction shutdowns we need to do in the next transition. As you're aware that we are taking one in November, and so that's something that we need to watch and see. Other than that, I think we believe the underlying performance is now starting to improve, and we like what we see there. As far as emissions in 2020, the compliance is concerned, we are comfortable with the compliance norms for 2020, and our plans and the roadmap for the future also factors in the ongoing compliances that are going to come up in the subsequent years as well. And given the mix of products and the launches coming in, particularly with the 3 new architectures coming in, does give us confidence that we are on the right track there. Adrian, would you want to, there's one question, I think Adrian has joined back in. There's one question on the emissions compliance for JLR for the year 2020, and what's your confidence on adhering to that?
Well, we know what the targets are. We know what the challenges are. At the moment, all of the actions we would need to take next year haven't been taken, but we're reframing our plans, and our expectation is overwhelmingly we will be compliant next year.
I appreciate the color. Thank you very much, and great quarter.
Thank you. Ladies and gentlemen, I now hand the conference over to the management for closing comments.
Yeah. Thank you. I think thanks everyone for joining the call. Once again, wish you a happy Diwali and season's greetings for others as well. And hope you get to spend some time with your loved ones in the coming weekend. Take care and catch you soon in the next call. Bye-bye.
Thank you. Ladies and gentlemen, on behalf of